thank you, Richard Murphy, for coming back on the show again. It means we can't be that bad. And
my wife's a fan. Come on, my wife is a fan. She tells me it's worth watching.
There's a lot going on in the financial world, in economics, that I can't really get my head around, and I'm sure lots of other people can't. Now, the first thing is, this is an article in the Observer on Sunday. Silicon Valley Bank's collapse will not be a one-off. The banking crisis was long overdue. Silicon Valley Bank is one of the top banks in the US, and that's collapsed. We've also had another bank in the US collapse, and we've had Credit Suisse has had to be bailed out by UBS. Can you tell us why those banks have gone under, and what the repercussions are? Is this going to be a global crisis, do you think, like 2008?
Well, I think there's a real fundamental problem in banking, yes. And I think it's easy to explain why there's a real fundamental problem in banking this time, which is a bit different from 2008. And that problem is that central banks, the Bank of England, the US Fed, the European Central Bank, and so on, have all forced up interest rates around the world, far more than is required to ever beat inflation. And they are obsessed with continuing with that. And what that does is force down the price of what are called bonds. And banks hold very large numbers of bonds. Now, they're UK government bonds, US Treasury bonds, which are the equivalent bonds issued by the US government, but also corporate bonds, because lots of companies don't have overdrafts. They issue what are called bonds. And bonds are bought by people, and the bond lasts for 10, 20, 30, in the case of UK government, up to 50 years. But the interest rate is fixed over the 50 years. So if the interest rate in the market goes up from, say, 1% when the bond was issued to 4% or 4.25% as it is now, according to the Bank of England, then the only way in which the bond can adjust for that to create the right rate of interest on it is for the price to fall. And the price of lots of bonds has fallen. What we know is that lots of these bonds are owned by banks. The Silicon Valley Bank owned vast numbers of bonds, which it had bought to get a return to pay the interest to its depositors. The trouble was the depositors wanted their money back, and the bonds had all fallen in value. So when they started selling the bonds, they made a loss. So every time a depositor asked for their money back, they had to sell some more bonds. They made a bigger loss. And they realized that that was just not sustainable, that the bank was going to fall over. And the moment people realized that the bank was in trouble, then everybody asked for their money back, and therefore Silicon Valley Bank fell over. And that's right. Also true of the Signature Bank in the USA. And what we don't know is precisely how much that is true of Credit Suisse. In fairness, we don't know precisely. What we do know is that UBS, the Union Bank of Switzerland, in other words, but give its full name, which has taken over Credit Suisse, asked the Swiss government for a 10 billion Swiss franc guarantee, which is about 8.8 billion pounds. So no small amount of money, to take over Credit Suisse, which according to its accounts and according to its auditors was completely solvent, to cover the hidden losses in its accounts. So what we know is that there's unrealized losses there. In fact, what we know in total is that US banking has at the moment supposedly got total assets of $22 trillion and total liabilities, that's money owed to depositors and so on, of $20 trillion, and therefore is meant to have $2 trillion of shareholders' money, which props the system up. What we also know is that there's some pretty reliable estimates that there are at least 2 trillion of losses sitting on their balance sheets, which they haven't included in their accounts. In other words, the financial support from shareholders to banks has been eliminated by central banks forcing up interest rates. The consequence being most of the world's banks are probably hanging on by a wing and a prayer, hoping that we don't all ask for our money back. And so long as we don't, they're all okay. But if anybody does, they're all in deep doo-doo. And the reason why they're in deep trouble is quite simply because they couldn't all find the money to pay us on demand. So that's not surprising. That's normal. Banks lend long, they give out mortgages, and they never borrow for very long. 3 or 4 or 5 years is the most that they ask people to put money on deposit for to earn a decent rate of interest. So there's always this mismatch between lending long, borrowing short. But it's got very bad in the case of some banks. So we know some banks like Signature Bank and Silicon Valley Bank in the US, and maybe Credit Suisse, have been caught short by this. And as a consequence, they've gone bust. Does that mean that all banks are in trouble? My honest answer is, and I gave a long interview on this yesterday to a technical journal, I don't know. The trouble is, we don't know because we haven't got the data to know. And because we don't know, we can't make a rational decision, and therefore people make irrational decisions. The last time that happened in the UK, many people watching your show will know this, was August and September 2007. Northern Rock went bust a year before the global crisis emerged, remember, and people queued to get their money back. Then the government said, you're all safe. So nobody had to queue anymore. They knew they'd get their money back from Northern Rock. That's what's happening in the US right now. That's what's happening in Switzerland right now. In effect, the US governments and the Swiss governments have given a guarantee. Everybody who's got money in those banks is safe. My point is, once you start saying that whenever a bank goes bust, and as far as we can see, every time a bank goes bust, this now happens, you say to the depositors, your money's safe. The government has effectively guaranteed every bank deposit. In that case, why do we need commercial banks? Why do we need commercial bank shareholders? Why do they need to make an excessive rate of return? Why do they get up all the upside when we, the public, get all the downside? What is the purpose of private banking anymore? And I think that's the really big question that needs to be asked, and which remarkably few people are. Larry Elliott is, but I'll be honest with you, he had a conversation with me before he wrote that article. I don't know whether that influenced him or not, but Larry and I know each other, and we had talked about this issue. Annie Blanchflower, who I work with, who used to be on the Monetary Policy Committee in the Bank of England when the 2008 crash took place, and I worked together a lot. He and I think there's a problem here. Why do we think there's a problem? Because the moment they give a guarantee on small banks, which is what they appear to have done, people in large banks will move their money to small banks until large banks get a guarantee. If large banks get a guarantee in the US, which is likely before anywhere else, people from the UK will begin to move money to the US. And this in turn is destabilizing. So we're going to end up with a situation where I think we're all going to get guarantees on our bank deposits. But then we have the question, literally, are we all banking with the government? In that case, does the government need to regulate all banking? What's the risk? What's the scale of the problem? How do we change banking? What do we do with those banks we've got? Do we let them still run some part of the system? We just don't know the answers to that question yet. But what we could be facing is the banking revolution we never got after 2008 and which we still need. There's a lot of thinking to do.
Right. Well, that's a very thorough answer. Thank you. Now, the next issue that I'm not sure about, we've talked about it before, is the Bank of England's raising interest rates. This is from the Guardian today, and it says Andrew Bailey has called on businesses to hold back price rises, telling them that interest rates will need to rise again unless inflation falls. I don't understand that. If he's saying that he can't get inflation to fall by raising interest rates and that people have to put prices down, isn't that mean that he's saying he's not in control of it? I mean, I don't understand how he can say you've got to put your prices down or we'll have to put interest rates up. Sounds ridiculous, doesn't it?
Well, everything Andrew Bailey says sounds ridiculous. I mean, the man is completely unable to do anything as a banker because he doesn't understand banking. He doesn't understand money. He doesn't understand economics. He doesn't understand inflation. I could keep going. I mean, I'm really not his fan. I think you've got that message by now. The point is that actually he has completely misdiagnosed the current problem. First of all, they keep on saying, and we had a former deputy director of the Bank of England say yesterday on, we're recording on Friday, so whenever you send this out, let's put it in context. He said it on Thursday. He said on Thursday that the job of the Bank of England was to impose a 5% pay cut on everybody in the UK. Now, I've never read that in their rules. I've never read them having been given that task by the government, but that's what he says the Bank of England's trying to do. And they're succeeding, of course. We are seeing real wages falling. And they say that's because we've all got to pay the price of the war in Ukraine. Well, the Germans aren't paying that price. The French aren't paying that price. The Americans aren't paying that price. Why the heck are we paying that price? So the Bank of England appears to have taken on a job it doesn't need to do by trying to crush the economy and force pay down. But it's also trying to use interest rates as a weapon when interest rates can't actually tackle the current type of inflation. Firstly, because it actually started outside the UK, and international oil prices aren't affected by the interest rate in the UK, nor are international food prices affected by the price of money in the UK. So complete nonsense that raising interest rates can reduce inflation at all, when almost all of it is imported in our case. And secondly, not only is that obviously irrelevant in that level, what Andrew Bailey is admitting in that comment, and it's a fair comment that Philip Inman from The Guardian has picked up, is that it's not wages that are driving up inflation, it's prices set by companies that are driving up inflation. And that's because profits of some companies are definitely rising. Now, not all companies, we can't say every company is exploiting the situation, because some aren't, but banks are. Oil companies obviously are, probably the large supermarkets are, some other retailers are. And he's saying unless they put down prices, he'll have to keep on putting up interest rates and crush the economy, but says that won't harm these companies. It'll harm ordinary people, those who actually have to work for a living. And so he's basically admitting that not only is his measure tackling the wrong issue, wages, because it's companies putting up prices that are causing inflation, and there is no wage price spiral, which is the obsession of the Bank of England and Rishi Sunak and the ministers who are trying to push down the wages of people in the NHS and elsewhere. But Andrew Bailey, the governor of the Bank of England, is also pushing up interest rates, which is simply going to deliver a recession. There's no way around it. And again, Danny Blanchflower and I have been working on this. We think the chance of a recession is well over 80% or higher. We actually called for a 1.5% cut in the interest rate this week, because first of all, that would solve the banking crisis, because the value of the bonds that they own would go up, so they would become solvent again. So no banking risk, pretty big win. Second, it would actually cut the cost of mortgages and the cost of rents, because rents are very close to the cost of mortgages because most landlords have mortgages. And third, it would, of course, therefore reduce the pressure on households who could therefore go out and spend money. I've seen another report in The Guardian this morning that says that Wetherspoons sales are down and they've gone into the black, they're losing money. And if Wetherspoons, which is the cheapest beer you can buy, my son tells me so, because we haven't actually got a Wetherspoons where I live, but where he goes, that's where he drinks, and he's a 21-year-old who's partial to a pint. He tells me that's the best place to buy beer. If that pint is going down or not selling enough, we can be sure we're heading for a recession. And so the Bank of England is heading us for disaster. The increase in interest rates, utterly, totally, completely unnecessary. All it's doing is making the banking crisis worse, making the cost of living crisis worse, and heading us for a recession. Complete disaster.
Can I ask you a quick supplementary on that? Should Andrew Bailey go, or do you think it would make no difference who the head is?
Well, this is worrying because of this 9 people who voted this week on that interest rate rise. 5 are employees of the Bank of England. All 5 of them voted for the increase. There are 4 who are not employees. 2 of them voted against the increase. 2 of them voted for. It's only 2 independently minded women who are on the committee, both of them economists, who voted against the increase. But given that the Bank of England is absolutely solidly behind this policy, it's hard to see at the moment, without a change of government appointing different leadership at the Bank of England, how sacking Andrew Bailey would change anything, because all he's doing is reflecting what Tory party policy is. So one of the first things Labour needs to do is look at his contract and get rid of him.
Right. Okay. Well, thank you for that. Now, the last question, you're doing really well on this. You're just top scoring on these answers. This was an article written by you in the Daily Mirror. Rishi Sunak may have published some tax info, but he hasn't told us everything. People did remark that his tax information was published on a day when other people were focusing on Boris Johnson's inquiry into his Partygate. So what is it that they're not telling us? What's Rishi Sunak not telling us?
Well, the total that he put out was rather short. That was it. I've actually got a copy of his supposed tax returns there, because I've done some work on this to write that article for the Mirror and to talk to other people about this issue. Yeah, even the Express. I talked to people like that as well. What he hasn't told us, he hasn't told us, apart from the fact that he's an MP, who pays him money. So we don't know, for example, even though he got last year £172,000 in dividends, that is payments of what is effectively interest on shares that he owns, we don't know where those shares were, what they were. We have no idea. So we don't know what he's got his money invested in. By the way, if he's making around 3% on his dividends, that implies he's got shareholdings worth around 5.7 million. It's tough at the top. And remember, his wife is worth vastly, vastly more than that. But on top of that, he also, and this is the critical point, made capital gains in the year to April 2022 of, I'll give you the precise number, £1,641,431. And he paid tax on that of £325,826, which is near as damn it 20%, because this is capital gains tax. And capital gains tax is at less than half the rate of income tax for people in Rishi Sunak's position with that level of income. And because he's so wealthy, he can arrange that he can make these capital gains by buying and selling shares rather than getting dividends or anything else. So he can reduce his effective tax rate, his total tax rate, in 2021-22 was 22 point, I've got it somewhere on my screen, I think it's 22.7%. We'd better get that right. Have I still got it open on my screen? No. Oh, no. Look, I'll open it while I'm talking to you because it will come up in a second. I'm right. It was 22.7%. Don't want to give us any legal risk by quoting a number, which is a decimal point or two out. So there we go. There's Rishi Sunak paying 22.7%. That's less than that's his overall tax bill. That's less than the overall tax bill of somebody earning less than 60,000 in the UK. Why? Because that person will, of course, actually be into the 40% tax rate. But remember, the 40% tax rate doesn't mean you pay 40% tax on everything. You've got your basic rate allowance, you've got your tax-free allowance, but you will be paying national insurance. And Rishi Sunak is only paying national insurance on less than 10% of his total income. And national insurance is big, it's 12%. So he avoids that and he gets capital gains tax rather than income tax. So first of all, he's avoided vast amounts of tax by structuring his affairs as he has. And secondly, he has told us what companies he owns shares in. And the critical point there is we don't therefore know whether he as Prime Minister has conflicts of interest because he's running the UK economy to benefit the companies in which he has shares without telling us, because he doesn't tell us what those companies are. And that's the whole point of requiring his tax return. We don't need his tax return to be nosy, although it's quite fun. But you know, we don't ask for tax returns from most people unless we think there is some form of conflict of interest, which means that they are not running the company or whatever it is in the public interest and are instead of running it in their interests. Because he hasn't told us that, this information is like, yeah, so what? I need some more. It's a bit like Oliver. Thank you. Can I have some more, please? And the more I want is, who do you have shares in, Rishi Sunak? Because that's where your conflict of interest is. And don't tell me you don't get any money from these shares or from that capital gain, because let's put it in context. His total income from Parliament came to about 156,000 in that year as Prime Minister. Fair enough. I don't think that's unreasonable for a Prime Minister. Some people will. I think that's probably okay. But out of that 156,000, of course, he paid tax, and his total tax bill in the year was 432,000. So, of course, he had to have had money from these shares just to pay his tax bill, because he couldn't even pay his tax bill out of the money he earned as Prime Minister. So let's come down to it. There's so many answers about things we don't know that the man just hasn't told us enough. He slipped this out on Wednesday when Boris Johnson was being pilloried by the Privileges Committee at Parliament, quite rightly, for all the lies he's done. But Rishi Sunak thought he'd be smart, get it out when nobody would notice. Well, we did. And the fuss has been made. And what's called tax Twitterati. Yeah, there are a bunch of us actually on tax, and we call ourselves the tax Twitterati because we all Twitter about tax. There's not many, but we've all noticed this. We've all pointed out this is nonsense. And so the articles are flowing. I hope the pressure continues. I hope he's forced to tell us more about his tax affairs in the future.